Okay, welcome everyone. Let's will start our new unit, which is the financial reporting. My name is Anjum Satar, and my email address anjum@ukversity.co.uk. If you have any question, please just drop me an email. Today lesson will go through LO1, learning outcome one, which is be able to prepare the financial statement for sole trader and partnership. So that will be key focus in our discussion. So the purpose of this unit is the aim of this unit to ensure the student have a sound understanding and technique, double entry bookkeeping, which we'll discuss as well, prepare financial statements, and we'll go through a different adjustment within financial statement and how we can prepare complex accounts. Okay, so each each week, each lesson will go through one learning outcome. So today will be focused on LO1, learning outcome 1, 1.1, 1.2. These are assessment criteria to pass if you want to work towards merit. We need to look around the merit criteria as well, and plus, if we want to work toward distinction criteria, so we have to address all these criteria to get higher distinction grade. So please, which when we'll go through our assignment discussion, so we'll discuss more in detail. Lesson 2 will go through learning outcome 2, and lesson 3 will go through learning outcome 3. We do 3 lessons to deliver this unit, and fourth lesson will be about assignment discussion. So each lesson we have indicative content what we're supposed to be learn. So today lesson will go through prepare financial statements, financial reporting for sole trader and partnership, income statement, partnership, capital, current account. That's all will be focused in our discussion. And who use the financial statement and benefited towards user, and what sort of decision they can make based on the financial statement. So that's all will be in our discussion. Okay, let's we'll start then. If you have any question, please you can ask. Okay, let's the aim of this unit, and always reflect when we start any activity. Reflect your current knowledge, how much you know, what you think about sole trader and partnership and financial statement. 1 to 10. Can you reflect yourself how much we know? Scale 1 to 10.
Yes, 13 I can say 9.
Okay, good. Okay, so always good to be reflective, and we'll see, can we little improve through this delivery or not, and we'll carry on improving ourselves as well. Okay, that's the indicative contents. And 1.1, we have a prepare the financial statement incorporating relevant adjustment for a specific sole trader. So first of all, we need to be know what is the difference between the sole trader, partnership, and limited company. So sole trader, we all knows, I think so, because of course we all working in accounts and you dealing with a number of clients. Sole trader is mean the 1% business, solely sole owner, all the risk and reward goes to 1%. Partnership, do we know how many partners can be in a partnership? Is there any limit?
30.
30. According to Partnership Act in UK, 2 to 20. If we have an insurance business in other part of the world, insurance and banking business, then can be 2 to 50. So normally 2 to 20, and we have a Partnership Act in UK, Partnership Act 1890 we use. If nothing is written between the partners, according to the Partnership Act, it should be shared equally. If we don't have a partnership deed, then of course we can share equally. Then the
Did you say Partnership Act of 1890? All
yes.
right, yeah, I can see. Thank you.
And then it's a limited company. Limited company, we have a Company Act 2006 at the moment we are following.
Yeah.
So that's, company is a separate legal entity. We can register in the company house. Of course, it can be public and private limited. If it's a public, you have to show minimum £50,000 worth of investment. And then, of course, you can register with the stock exchange. And private limited, of course, we can register with even £1. Huh? Okay, next, the different types of organization. Non-profit, of course, we can register charities under the charity.
Sorry, can I interrupt a little bit?
Yes,
you
sir.
mentioned public private companies. We know we have incorporated and unincorporated. Can you lay a little bit of emphasis on unincorporated companies? What do they stand for? What are they?
Sorry, yes, just I will go back to.
Yes.
Okay. So limited liability company is a limited company. Then we can register in the company house. If it's a private limited company, you have a private investors, and we registered in the, of course, both registered in the company house. But if you want to be registered PLC, there are more documentary requirements. Of course, because private can issue shares to the general public, and they need to be at least £50,000 worth of investment. Yes, they have to show they have investment of 50,000. And then, of course, they can register it as a registered capital, and then the company house, and plus, this, then they can register in the stock exchange as well. Sorry, you want anything else? Maybe you're not getting.
Yes. My question is regarding, before we get to the limited or not limited, we have corporated or on the incorporated or not or unincorporated. So I wanted us to explain the difference between incorporated companies and unincorporated companies. Before we now go into whether they are limited or whether they are not limited.
Okay.
So the difference between limited, the difference between incorporated companies and unincorporated companies.
When the incorporated mean you registered as a corporation, you have a separate legal entity. It's a separate name of the company. So if you're a corporated and the F has written LTD, it's a limited liability. It means nobody can claim, from your personal asset. Uncorporated mean you're not registered it. Yes. So you're not as a corporation. So it can be raised to your liabilities unlimited. So incorporated business is a registered, that is a corporation tax apply as well.
Right. Yes. In other words, unincorporated companies, they are equivalent to private enterprise.
Yes, because not registered. So it's not applied the corporation laws, the Company Act, because you're not registered it.
They're required to file accounts with HMRC?
Yes, they have to. It's a corporation. Yes, corporation. It's a incorporated business. Corporated business, you registered.
Well, an unincorporated business doesn't have to file accounts, only has to actually file income statement or the tax return. There's actually no requirement to actually send accounts. They're actually filing information under self-assessment, whereas a limited liability company does have to file accounts at company's house. A sole trader or an incorporated business does not only needs to provide HMRC with its income statement, which is actually contained in a tax return. It doesn't have to actually send accounts per se.
Yeah, correct. That's what is done in practice. Thank you.
Well done. Great. That's that's a good point. Well mentioned. Thanks, Jeff. Okay, we'll move to the next. Okay, then we have a charity. Charity we registered under the Charity Act 2011. Then we can clubs and non-governmental NGOs. We can as well. Of course, they have to submit their accounts to Charity Commission. So Charity Act 2011, please, if you want to remember. Okay, that's the key limited liabilities. Then we have a IES. Do we know IES? What is IES?
International Accounting Standards.
Yes, International Accounting Standard 1 is about preparation and presentation of financial statements. So we can follow IAS or we can follow FRS. Huh? It's called Financial Reporting Standard in UK. Local standard we can follow the gaps. It's called Journal Acceptable Accounting Practices, a principles. But depends which one you want to be follow or where your company registered. We have to decide. Only the slightly layout difference, and overall, there's quite similar things. Okay, partnership advantages, disadvantages. Of course, you want to start. You can be one. Y'all risk and reward yours. Can goes to so partnership. Of course, is a higher capital, more skills, but there can be a conflict as well. Then companies, we all knows company we can register, and under IAS 1, always we need to be make sure prepare statement true and fair and provide the right information to the user. And there are many standards. The limited liability partnership we can register as we start as a partnership, then we can register in the company house, LLP, especially accounting firms and solicitor firm, normally LLPs partners. So that's we can register. Okay, then double entry bookkeeping. So please, when you deal with the double entry, of course we know double entry, we learn it in different. So we can maybe remember the word that click, what goes on the debit side, what goes on the credit side. Of course, especially when we're using the software like Zero, like Slate, like QuickBook. Of course, we need to be follow the nominal code, but the basic accounting logic is the double entry. Yes, because the nominal code can be cleared automatically. Okay, so that's we have double entry bookkeeping rules which we can follow. And when asset increase, we do debit. When asset decrease, we do credit. So that click, what goes expense, asset drawing goes on the debit side. Liability, income, and capital goes on the credit side when increase. So when decrease will be opposite. Okay, then for the asset increase, debit, asset decrease, like the credit. So these are all the rules which we need to be follow when we'll do the double entry book. Any question?
No.
No.
Okay, then we have a depreciation. Depreciation is expense for business. Different depreciation method. We have a separate IAS 16, which is about PPE, property, plant, equipment, and the depreciation method we can use it straight line. We can use it sum of digit. We can use it diminishing or reducing balance method we call. So carrying value mean after the depreciation, what is the value left? So the cost when we bought it, accumulated, how much been depreciated equal to the carrying value. Okay, then of course we discuss, these are the methods we can use it. And we can prepare non-current asset registered separately, NCA, and normally in the balance sheet show the final figures. And in the notes we can give the detail. But is a separate non-current asset registered, can we make separate adjustments? Any question?
No.
Okay, then in business sometimes we have different types of errors. So it can be types of error, original entry, maybe we not put in the right entry. A reversal, we can reverse it, maybe we put other way around. Because normally you will see, the sale ledger control account we supposed to do debit, and the sale we supposed to do credit. We can put it vice versa. Principal errors, expenses goes on the debit side, asset goes at debit side. Maybe we are saying it's the expense. If we are saying expense instead of asset, it means we're reducing our profit. So we need to be follow the basic, the rules of double entry. We need to be our financial statement true and fair. So that's why we need to make right adjustments if we make mistakes. Or of commission that can be and entry of duplicates can be, and accounting balances can be incorrect. So what we need to do, we need to make sure we'll make the right adjustments. Huh? So these are all the types of errors. If you have a question, you can stop me, please. Welcome. Okay, next, sale tax. Of course, we know VAT. VAT is normally 20%, 5% reducing rates, but we in VAT control accounts normally we include in our final accounts. That's why we have. Then driving missing figures for incomplete record. Sometimes we have a missing figure. We can find the incomplete record. So we can, like, sale ledger control account, we can prepare. Sale ledger control account, also known as trade receivable, also we call that interchangeable names. We carry on using accounts. According to International Accounting Standard, we should use the sale ledger control account. Okay, so okay, opening receivable sale, and then if we have cash receipts, our receivable go down. No? If we need to find the discount allowed figure, so we can find through different. So discount allowed is expense that come on the credit side in the sale ledger control, but in discount allowed ledger will goes on the debit side figure. So we can link it double entry bookkeeping with two ledger. And a purchase ledger is the opposite of sale ledger. Okay, then we have an incomplete record. Do we know what is meant by gross profit, markup and margin? Okay, so do we know what is the difference between markup and margin?
Forgotten.
Anyone? What is the difference between markup and margin? Can you hear me all?
Yes, I can hear you. I have forgotten.
Okay, markup mean the cost plus. So if the word markup being used, it means 100% is the cost, and whatever the percentage of the markup is given, that meant by gross profit. If the word margin being used, it means 100% on the sale. So your gross profit is based on the sale. So like here, if we'll see, so we've been given the gross profit is 25%, the cost of sale, and the term we can use markup. Okay, so if the margin we can say is my sale is 100%, my gross profit is 20%, so my cost of sale is 80%. Because the margin means the gross profit is based on the sales value. And if we have markup, then we should say the cost of sales is 100% and the sales will be 125. If you bought it 100, so you should kept the price is 125 up. So these term we are carry on use. Okay, so we can make the adjustment if we need to be cost of sales, goods sold, gross profit margin, any adjustment in the closing inventory if we need to. So we can.
I'm sorry, I missed the previous one you explained. Can we go through that markup and margin? You initially said that markup is based on the cost.
Okay.
Maybe if the cost is 80, we say markup is add 80 to 20.
Okay, we use the here term markup. If let's say in the question is a given markup 20%, yes?
Yes.
So you set your equation. Always comes sale first, we know all, yes? Then it comes cost of sales, and then we find the gross profit, GP. Yes.
Yeah.
So whatever is the word markup or margin, the percentage is mean the gross profit. So in this question, if the word markup, so you can write your cost of sales is 100%.
Right.
Yes.
Mm-hmm.
And if the now your sales will be
125.
120%,
Yeah.
and your gross profit will be 20%. Huh?
Yeah.
Yes. Any of figures given. If I suppose I know my gross profit is 200, I want. So you can always the percentage you know you divide it. The percentage you need to know multiply it. So
Yes.
200 divided by 20 times by 100. So I can find my cost of sales.
Mm-hmm.
If I need to find my sales, so I'll divide by, because I know 200 is a 20%. So I'll divide on 20, I multiply with 120. So I can find my sale figure. So missing record we can find through using equation. So when is the word margin being used, if so same this time word margin, let's say margin is written 20%. So you set the same way the equation, the sales, cost of sales, and then gross profit. So this time now my sales will be 100%.
Mm-hmm.
So my cost of sales 100 minus 20, because 20 will goes to my gross profit, so 80% will be my cost of sales, and
Okay.
20% will be my gross profit. Huh?
Yeah.
Okay, that's the way we can say.
Okay.
Okay, let's
So
move.
imagine we take away the gross profit from the sale
Yes,
to
so
get the cost of sale.
gross profit will be based on the sale value. Huh?
Yes.
So that's terminology is different. Huh? When
All
we
right. Thank you.
welcome. Okay, then we can make a closing inventory adjustment if we have inventory sometime can be. Okay, inventory we have for inventory especially we have IES 2. IES 2 it's called the International Accounting Standard 2, which is about inventory. Inventory have three types: work in progress, raw material, and finished goods. Three types. So inventory should be recognized in the book of accounts either at cost, or net realizable value, NR, NR, net realizable value. Like Window 98 CD, you bought it £200 and we have in our warehouse, and we have a stock £200 worth of stock in our warehouse. Is it still Window 98 £200 each CD? Software? Maybe no one is happy to pay more than £10. Yes.
Mm-hmm.
So no, we should reflect in our book of account £10, not 200. So next 190 is our loss, which we should put in the profit and loss. Okay, so this is all about we should reflect it, because when inventory value carry on going increasing and decreasing, and but we always shows lower, not higher value, because we want to tell the true story, because the value can be go up and down, but we don't want to overestimate. Okay, cash book always
So what is the effect of overestimation of stock value in the
so if I'll carry on recording £200 in my account, even I pay £200, yes, I'm not telling the true, what we said earlier, true and fair
Yeah.
information, because I'm telling, then somebody can make the decision my company value is higher, and then maybe in a nutshell my value of company is only £10 instead of £200. Yes, because that's why we need to be make sure we'll A couple of you heard about creative accounting. Yes, creative is all about. We just need to be make sure. That's why the standard carry on coming. But still, Enron, World Telecom, Trillion, and various other companies collapsed due to did not follow the standard properly, and the new standard arrived. They under and overstated the things. Okay, so some people are very creative. Huh? Okay, so but as a
So
ethical,
my question is, what effect will it have in a report we're talking about in practical terms?
yes,
Assuming an organization has this culture of overinflating their stock value, and we are now carrying out an audit of that company, and we discover this, what effect will it have on the reported statement?
okay, so if I reported 200,
Yeah.
the user can say that this company have a high value of assets, and if I'll go to the lending company, they can say, oh, this company have the asset, so we are happy to give you loan. But actually, the net sell, you don't have the value of asset. Yes, if you don't it, so it mean actual the company value is a very lower, but we manipulate it to show higher. So it can be affect various users. So that's why the new standard carry on coming to reflecting, like recently standard being released IFRS 16, which is about leases. All the company never shows the operating lease agreement, how long you're bound. They just carry on putting as expense what they make the payment. So now IFRS 16 says you should record as an asset and you should record as a long-term liability, and then carry on reducing it every year, which reflect that's the liability and that's the asset for the long term. And in the notes, you should give the description as well, because that wasn't on the that was kept off the balance sheet.
So what I'm trying to say is that an overvaluation of stock is likely to overrate our asset value. It's likely to overrepresent our asset value.
Okay. If the stock value even go up, let's say we bought it 200, but the stock value is at 300, when we sell it, we can gain it. But normally for the statement under IS2, we show always lower value. So we can show what the value which we bought it or the today value, whichever is a lower, not higher value.
Okay.
Because we're not attracting to be invest in our company. Huh? Even maybe in real value, it can be higher. Huh?
Right.
Okay, so cash book can be debit and credit side always. So debit side is mean receipt, credit side mean payment. So other correspondence ledgers will be opposite side. Some people they paid the accounts, prepare the accounts based on their banking, based on the cash. So that's always we do opposite. So if you have a debit the cash, it mean maybe you have a sale, because that's why your cash received. That can be a cash sale, so you can do the sales credit and the cash debit, and cash goes in the balance sheet and the sale goes in the profit and loss. Okay, so I included all some information in these slides that will help us. Debit and credit rule, drawing means something. Please, can you mute it, please? Who's I'm not sure. Hello. Hello, please. Can you mute yourself, please? Try to mute. It's not working. Hello. Please, can you mute yourself? No, I'm not sure who. Hello. Hello. Can you hear me?
Right.
Hello. I think so.
Hello. Can
I think so.
you,
It's better now. Okay.
Yeah.
Let's please. Okay. So drawing is mean anything you draw for personal use. So that's we need to. Okay. Then next we have accrual and prepayment. Accrual and prepayment, of course, when you deal with it, please always draw the timeline when my year start, when my year finish.
mm-hmm.
And accrual expense is a liability. Accrual income is a asset, which is opposite, yes. And vice versa. Prepaid mean advance paid. Prepaid expense is a asset, and prepaid income is a liability. Okay, so we can make adjustment accordingly in our book of accounts. Any question, anyone?
No.
Okay. Then I included the template how we can prepare the statements. We know all sales revenue comes first. If we have any other income discount received for suppose we can include as well. And the sales minus cost of sales equal to gross profit. If we have a discount received, add it. Expenses, all other indirect expenses you minus will get the profit. So cost of sales, we can use the formula opening inventory plus purchases minus closing, and all other expenses we can minus, so we'll get the profit. Profit can be before tax, after tax, yes, depends, yes. So, and we can prepare our statements. Statement of financial position, non-current asset, long-term always come first. Non-current mean also fixed asset. Asset mean anything you own which we can use for number of years is called asset, which will flow the future economics benefit. Current assets short term which carry on changing within 12 months. Non-current liability, the legal obligation. Liability, the legal obligation we have to pay. But non-current means the long term which will takes more than a year. Current liability which we need to be settled within a year. Liability mean legal obligation. So accounting equation, asset minus liability is equal to capital. Asset minus liability is equal to net asset. If you know net asset figures, it means you know your capital figure. So we can make adjustment if we need to, and we can prepare a statement. So this is all been explained, and a financial statement, and we can show working financial statements as well. And then I included some question for you, which you can go through your end, please,
Yeah.
in your time. And can you see this? Yes.
Yes.
Handout. So is the answer there? Okay. So if you go through chapter 3, and then you can go through 3.5 this task, please, in your time to prepare. That will help us to be. This is okay. Sorry, I'm looking at that. Okay, that's chapter 3, please. So I just mentioned in your own time, always good to be go practice because you are working in accounts. So you have a basic good understanding. So please, you can prepare the statement for sole trader. Huh?
Mm-hmm.
You can. So that will help us. If any question you can ask, or you can look around in answers. So I'll upload answers as well. Huh? So that's all will be on Moodle. Other than that, if you want to do practice and you think, I need to really little bit brush up myself, so copy this link. Okay, copy this link and please you can do this little test. Indicate which one calculate the profit for the year. What do you think?
It's nice. It's good. Yeah.
So you can say I'm right and wrong. Yes, statement of profit and loss, and you can do with adjustments as well. Further question. So if you can't dig out which one, at the end will show you all the answers as well.
Yeah.
Okay. So then we have 1.2, which is about the preparation of financial statement of adjusted. It's a partnership. So we know partnership have many partners up to 20 and we can make adjustment. So key difference between sole traded, one, partnership can be many. And in partnership, we prepare the partnership appropriation accounts. Yes, so we need to be like here is example. Profit we prepare normal and then we have a salaries of partners. So salaries for partners is expense for business. So we'll minus from it. Interest on capital is expense for business, but is the income for individual. Sale commission is expense. So whatever the profit will left and whatever the sharing ratios we are agree, that will distribute between partners. Like here, we have a profit and then we have a 40, 20, and 40% our distribution ratios, so we can distribute our profit. And then, of course, we can prepare the partner's current account or the partner's capital accounts as well. So the work is exactly basic, the logic as a bank accounts in the business. Okay, then I included 2.1M, which is about the prepare financial statement in trader and partnership. So we can show what is the key difference between sole trader and partnership. So of course, in the partnership, you will see the partners, yes, capital, but the sole trader is the one person. That's the key difference. Okay, so then capital accounts we can make in partners. We can show separate partner A, partner B, partner C, but in the sole trader it will be one. So current account we can show the salary, the income for individuals, and but if they do the drawing will reduce their current account balance. Interest on drawing is the income for business, but is expense for individuals. And then they have balance. Yes, whatever the balance they have will this carry on. It can be overdrawn, it can be positive. We can add new partners. Partner can leave the company. So goodwill. So if you are many years in the business, we create the goodwill and we eliminate the goodwill. So goodwill will affect the partner's capital accounts. Okay, that's we need to. So in the like here in example, goodwill will be debit in the goodwill ledger, but in the capital ledgers will be credit according to if the new partner will join, then the capital account of new partners. So we do after introducing first, and then will they do the debit their account capital account will credit the goodwill. Same goodwill will create and we eliminate. Okay, then I copy the link. If we know the stakeholders. Stakeholders mean anybody who has any interest in the business is called stakeholders. So the various stakeholders and what sort of the bank they use the financial statement to prepare and decide either to give the loan or the lending to the individuals or not, and the customer they're looking. So I included all these stuff their links, so that's quite good for you. And other than that, for partnership, if you want to, don't know what's happened, not saved here, so you can look around chapter 6, please. Chapter 6, which I gave you the handout Osborne. So please look around task 6.5 and task 6.6. And plus within that test, which I mentioned you, here is a link as well. They also help you and clear the understanding. So this is the partnership questions you can go through. Please in the chapter 6. Huh? That will be available on Moodle as well. Huh? So you can, and especially when we prepare assignments, so we can include example from this handouts as well, huh? To meet our criteria. So you will see here with the adjustments, and we've been asked, and changing partners, partnership, partner leaving and joining. We have a lot of example there, chapter 6 and 7. So you can go through 6.3 and 6.4, huh? The task, and that's about the partnership adjustments. Any question?
Yes, can I ask, you mentioned, can you hear me?
Yes, yes.
Right. You mentioned, you made a mention in goodwill, where which we said we have to debit goodwill and credit the partner's capital.
Yeah.
Now, when we are assuming we are doing an evaluation of business, maybe you go to the bank wants to evaluate whether this business is they have strong capital or they have enough assets to warrant bank giving them loan. Why do banks sometimes discount goodwills? And what effect will goodwill have if we exclude it from the business?
Okay. First of all, goodwill is an intangible asset. We can't see it. Standard not allow us to be include the goodwill which we have created, internal created goodwill. So because it's a definition of asset, anything a definition of asset, because the goodwill is an asset first. So you have to look around, is it meet the definition of asset? Asset is mean any a resource controlled by entity which will flow the future economic benefit. If the goodwill will give you future economics benefit and you can measure reliably how you will estimate it. Yes, is it when, let's say my net asset is 100,000, yes, and the people are willing to pay me 150,000, yes. So why people are paying me 50,000 extra? Because my asset is 100,000. They are willing to pay 50,000 extra due to the goodwill. Yes, and that's we can say that's. But if you took other company, you bought it that company, and the company was asset was 100,000, but you paid 130,000 for suppose to buy 100,000 asset. So why you paid 30,000 extra? So what you paid extra, that you can put in the asset in your balance sheet as a goodwill, because that's why you paid extra money to buy the other company as a goodwill. Yes. So that's we can. But in the partnership, because that's you're not extra, because you're doing business many years, and someone you can estimate what is the new partner will contribute towards your goodwill which you have created. Because if somebody join after 5 years and say I'll share equally, and you joined 5 years ago, so that's not a fair, because you put your time, your effort. So we can estimate the goodwill. So if the goodwill account debit, so old partners according to the old ratio their capital account credit. When the new partner will join, then the new partners we will be the new ratios. So according to the new ratios, we'll do goodwill credit now in the goodwill account, and the capital account will do debit according to the new ratios between the partners. So it will affect only the capital account. So old partners will get benefit of it, and the new partners capital account will be lower. Yes. So that will affect.
Can I ask another question? I'm sorry, I'm
No, that's
being too
fine.
inquisitive. But what is the criteria for valuing goodwill? Is there any pronouncement, either in IAS or in other pronouncements, where
So we are
have
saying
a criteria?
IS 36, and you can look around IS 38. Okay, first of all, you need to be find the definition of assets. Okay, if that meet the definition of asset mean anything you own it, anything which will flow the future economics benefit, and any money you spend to build the asset which you can measure reliably, like research and development, R&D, So you can't say research and development is your asset if you don't, like coronavirus vaccine, GSK, GlaxoSmith and clients. Yes, GSK, GlaxoSmith clients, they have did research, yes, and their research proved this medicine, this vaccine they are going to make it is £1 million worth of the benefit will generate. So what basis? So we have all trial and test. We have a facility to make the medicine. Yes, we have asset, machines, and everything, and then we can put it whatever the money we spend on the research and development as a goodwill, as an asset in our book of account. But
So are you saying that goodwill is based on cost and not future benefits?
it can be only when you can say this will be asset and meet the definition of asset. Asset is mean anything you control it, anything will give the future economic benefit. If something not give you future and you can measure reliably, can we measure reliably? Is there any reliable criteria we have? If we have, then we can. Okay, is it make sense?
Yeah, it does make sense.
Okay, so that's, if you want me, I can send you, some handouts later on. So
yeah,
you
I
can.
would like to have, please.
Yes, sure, no problem. We teach, in other unit in more, detail the IES. Or simple, if you type, in IES 36 and IES 38, yes.
Yeah.
And look around, and next to that, type Kaplan, Google search, and there's a lot of examples will come. Okay, Kaplan is a publisher, so we have many resources. Okay, this is the link from the Kaplan as well. So if you have any question, please you can drop me email. So today we discuss about financial statement. We discuss sole trader partnership. That's all was today lesson. And in the next lesson we'll go through LO2. Okay, so please go through handouts. If any question you can ask, and all the handouts will be available on Google. Any question before finish?
No problem. We've got a session at 2 today, Angela, haven't we?
Yes, should be. I think so. Have you received the invites, huh?
Yeah.
Okay. Yes, then should be. Yeah.
I'll see you this afternoon. Thank you very much.
Thank you. Bye bye.
What time will that be? What time is